All right, we have made it through the countdown. I'm getting the profit tracker loaded up. Give me 2 seconds. There we go. And we are back for another super exciting week of talking about option selling. I am just on the edge of my seat, and I'm sure you guys are as well. We have got a 3.5 day week in the market. So, not a lot of time for things to move against us, but the way luck has been recently, I wouldn't put it past us if that did happen. So, we're going to be prepared for it, but I think we've got a good plan. Uh, Again, another rough stretch of luck, but overall, we finished up June with a profit, which, if we're having things move against us the way that they have, and at the end of all of that, that 3-4 week stretch, we can look backwards and say, hey, we made money. Those are the best types of lessons to learn in the market. If you've got things running against you and you're still pulling in a little bit of cash. Now, we're underperforming because the market ran up a really good bit, but halfway through the year, we're still in a very, very good spot. So, without further ado, let's talk about it. Let's talk about what happened last week. Let's go to the standard presentation. We are good to go. Okay. Hopefully that's big enough for you guys. If it's not big enough, feel free to let me know, and I can make the text a little bit bigger. So last week we lost $343 to finish off June. Now, in more of a macro sense with how we're doing over the entire year, we took home a profit of $838 on the year. Now, it's always a great sentence when I could say, hey, our profit of $838 last month was our worst month of the year. But, is what it is. And we can only control what we can control. Now, the way that our strategy goes is we kind of dictate our moves based off of RSI in the market. And RSI in the market lately has been running red hot. And I think if we pop this open really quickly, what we'll see, if we go to RSI, we'll see, boom. The S&P 500 is at 68.11. Consumer discretionary is at 70.51. So that's really the only one that's officially overbought. But a lot of them are knocking on the door of that 70 level. QQQ as well. I got to put the study back on there. Give me 2 seconds. Boom, 71.11. No, that's the 20-day. 65.72. There you go. So all these large indices are overbought. Anytime we get into a situation like that, we're going to want a bearish portfolio. But we also want to balance that out with some bullish trades as well, just in case the market keeps going up, right? And that helped us out a little bit last week. Cash Money in the Twitch chat. What's going on? Welcome to the stream. Thank you for spending your holiday Sunday night with me. And happy 4th of July. So, top to bottom, let's go through what we had last week and how this culminated with a $343 loss. Now, again, big picture, we had a lot of these short positions. We were short on RCL, Wayfair, Meta. Let's see what else we had. PANW, UAL, U. That's 5 different bearish positions that were a pretty large chunk of our portfolio. And the market ran up over 2%, and we only lost $343. And in fact, there was one big mistake that I think we made that would have turned that into an overall profit. So let's talk about that first. And conveniently, it's at the top of the list. And it was RCL. So RCL, if you were following along with that one, was probably the source of a ton of frustration over the last few days. Now, if we put this thing on a 20-day basis, it's been ripping, right? Big picture, we talk about RSI. We go back to that 1-year chart, 79.65. And this thing has had an elevated RSI for a very long time. So it's one of those situations where I feel like it's bound to come back down. But again, we always want to be careful with the position that we hold each week. And we don't want to get too aggressive, right? The way that I viewed last week is we dodged a little bit of a bullet. I mean, on RCL, we still lost $1,236 on that position by itself. So not the best, but we had some other winners that balanced that out. But again, we don't want to put ourselves in a position where we roll that entire position forward. And yes, I do think it'll dip back down 100, below 100 at some point, but at the same time, we also didn't think it was going to run up past 100. So it's clear that nobody really knows what the future holds in the market. So we want to make sure that we're being smart about it, and then we give ourselves cushion on a week-to-week basis. So what happened with this one, and why this is our one mistake of last week, is this is Monday morning right here. This is the previous Friday expiry. This is Monday morning, and what you'll see is we had these 96 strike calls that we sold for 296, and it was about to be great, right? We were going to have these things expire worthless under 96. We were going to make $888 on it, and life was going to be good. However, We had a disgusting fake out. And you talk a little bit about luck in the market. Things like this can drive you crazy. But again, one of the larger points that I think is important to drive home here is that yes, it sucks that it moved against us, but we could afford to have it move against us because, again, this was a pretty nasty move against us. We lost a decent bit of cash on it, but overall, it didn't kill our week. So, in that sense, we were able to sit back and wait for it to try to move a little bit more in our favor. However, we had this huge red candle because Carnival Cruise Line reported earnings on Monday morning last week, and it didn't go very well for them. So off the bat, it went from 98 down to 93.65, and we said, okay, we're in a great spot. And now what we did do well, to our credit, is we had 3 of these contracts, and what we did was we closed one of them for $1.29. Now, this is where I think the mistake was. I think it was smart that we closed one of them for $1.29. However, if we closed all of them for $1.29, what you'll see is we would have made $501. We would have never needed to open either of these positions, and we would have taken home a nice $1,400 return on the week. So that was probably the biggest mistake that we made. And again, there are a lot of situations in the market where you're going to lose money and say, oh, that was a mistake. Just because you lost money doesn't mean it was a mistake. For example, Wayfair, I don't think we really did anything wrong there. We lost money on it. But RCL, we definitely could have done a little bit better. Because last week is another great example, and it's a point that can't be emphasized enough, which is just how long a week in the market is. Because that happened Monday morning. We had a 96 strike, right? And if you kind of zoom in here, what you see on the one-day chart, yeah, we get max profit above here, and it was trading down here. So we thought, okay, great. We'll close one out. We'll let 2 ride, and then we collect maybe 200, 300 more bucks. And in holding out for that 200 or 300 more bucks, again, we went from making $501 if we just closed the whole position out to our current situation where we lost 1,200 bucks on it. So getting out of those larger positions early in the week, I think, is key. Now, if RCL was sized like Wayfair, or it was still a credit spread, or Meta was still a credit spread, we could have afforded to wait it out, I think. However, it was definitely one of our larger positions with 3 contracts at a 96 strike. So getting into those larger positions is important because that's how you average into trades. But likewise, when you get the move that you want, and we got the move that we wanted, right? This was the move we were looking for, this big red candle. It's equally important that we get back out. So that was our one big mistake last week, and that was what took us from green to red. Now, there was one other trade that moved against us, and there were a couple that moved against us, but there's only one other trade that we lost money on, and that's going to be Wayfair. That was one where we started with the credit spread, a 60-65 credit spread, and then we did what we call kind of taking the top off the credit spread, where we know that a credit spread, a call credit spread, a 60-65 call credit spread, is where you sell a 60 strike call and then buy a 65 strike call behind it. Again, it creates a defined risk, defined game position. Pretty safe way to bearishly play something back down. However, it ran up pretty sharply on us. And if we go to the Wayfair chart, we're going to see just how sharp this run was. Again, another one where we back up to the 1-year chart, 80.8 RSI. Now, it's a decently shorted stock, so I think there's a little bit of risk, which is why we've had a little bit smaller of a position that we've held onto. But if you take a look over the past 1 year, yeah, it runs up sometimes, but we're getting into this level here, the mid-60s, high 60s, where historically when it has had those run-ups, it's fallen back down. So I have a little bit of confidence in taking that spread off, in addition to the fact that next week is 3.5 days. Now, that's still plenty of time for something to happen, but I think with where we rolled this position to, it wasn't too bad. So let's talk a little bit about how we started this position off. Again, it was a 60-65 call credit spread. We had a 156 credit and then a 58-cent debit behind it to create it. So we had a 98-cent spread. So again, our short leg was 60 right here. We had a 98-cent credit. So our initial break-even price was 60.98, which if you go to like the 10-day chart that we're looking at here, really not a bad place to start. Again, 623 right here is where last week ended. Last Friday at close, Wayfair was at 57.38. I mean, it was in a great spot. Our break even was at 60.98 all the way up here. And then, of course, as things go sometimes, massive green candle. Tuesday was exclusively green candles. And by the end of the day, Tuesday, when it hit 65, right, what happened? It hit our long leg. What we did is we closed that long leg for profit. Why did we do that? Again, this is the initial break-even price. We can maybe even type that in. And we needed to manage the position because we had a break-even price of 60.98 and the stock was trading at 65 on Tuesday afternoon like this. So what we do is we take that 65 when it hits the long leg and we close it. And the question is, why do we close it? And the answer is because in a vacuum, these are two long calls at 65. The stock is trading at 65. So if nothing happens between that point at Tuesday afternoon and then Friday afternoon and it stays at 65, and spoiler alert, it did, it finished at 65.01 on the number, these are going to be worthless. So what would have happened here, when we took profit, we made $130 on those. If we didn't take profit, and again, overall it netted out to negative 568. If we didn't take profit, these would have been worthless and we would have lost $814. So we saved ourselves about $350 on this position by closing out those long legs. And the great part about this is we talked about that 60.98 initial break-even price. Our new break-even price after doing that gets even higher, because if we think about this, after closing out the 65 strike calls, what are we left with? We're left with the 60 strike call, the short leg, which our break-even price will be 60 plus 1.56 because we sold it for a 1.56 credit. And then we actually increase our break-even price by the profit on this one right here, which is going to be 65 more cents. So our new break-even price, B/E, is 62.21. So by taking the top off of the spread right there, we increased our break-even price on a bearish position by $1.23, just like that. So we went from let's get this line out of here. We went from 60.98, which is right here, up to 62.21. Now, again, that's not a ton, but it's important to emphasize this was a Tuesday afternoon, and at the point that we had done this, basically we had 3 days left in the week. And going from here to here is decent because the week after we could just roll these again, and that's exactly what we did. So what we did was next week we rolled these to 66 strike calls. And on Friday, I think it was, we rolled 63 strike. We rolled the 60 up to 63 just to try to collect a little bit more of extrinsic value. And really, in the end, it was kind of a wash, because if we had let these ride, they would have been worth 501, and then we lost $50 on the new entry. So more or less, there wasn't, an eventual result of a benefit, but that was the idea between switching from 60 to 63. So all in all, we're in this position where we lost $618 on Wayfair last week. But again, we don't necessarily want to try to do anything crazy because, again, Wayfair can run up pretty decently. We're in a position where we had a lot of winners, so if we just get a little bit back on this and decrease the magnitude of the loser, that's going to be a decent result for us. So what we did is we rolled that to next week for a 66 strike call for 225 credit. Now, again, we lost 618 on it last week, so this is only going to make us back 450, but if it does, we've only lost $168 on a bearish position that basically did this against us in a very short time frame. So now we just need to hold 66, and again, we kept two contracts. We always want to keep size low because our first line of defense, outside of taking the top off the spread like we just talked about, our first line of defense is increasing that position size. So if we are in too large of a position off the bat, we're not going to be able to do that. Here in the YouTube chat, what's going on, man? Thanks for checking in. So that's what we've got next week. So RCL is a roll forward position from last week. And again, we took a pretty big L on RCL. $1,236. We're not going to try to make it all back. We took a step back and said, hey, we lost $343. We got out of June profitable. Let's not necessarily wipe the slate clean because we're going to keep some of these positions going. But let's just continue forward with maybe a little bit of an objectively safer position. So instead of rolling these RCL calls at like 100 or 101, we're going to 105, a much higher probability trade where if I pop this up and we go to RCL, keeping it below 105 for the next 3.5 days, I think is a lot more reasonable, especially since if we look Wednesday afternoon, 105.21 is about where RCL peaks. So we're in on those 105 calls, the 66 strike calls. Faux Life in the YouTube chat as well. What's going on, man? Thanks for checking in, guys. And I think those, they're still showing up on the screen in the bottom corner, the chat messages. So that's two of our three positions. The third, we have more than three, to be honest. I have not fully updated this yet, so you're going to have the painstaking exercise of watching me update this as we talk about our positions live for next week. However, let's talk about some things that went a little bit better for us, right? It's really useful to talk about the losing trades because that's where we learn the most and can adjust the strategy moving forward. And again, our big takeaway from those losing trades last week is to say, hey, our biggest loser was a position where we got a move we wanted off the bat. In fact, first thing Monday morning, we got that move that we were looking for. but we just didn't take it. So again, of course, this is like playing the game of ifs and buts, but if we just close out for $1.29 and never have to manage this position, we're looking at a $1,400 week. And of course, if we put that on the year-to-date summary, it looks a lot better than taking a slight dip back down. And then we end with $2,500 in June. So one small action on a Monday morning could have taken us a long way there. Anytime you've got a decent chunk of profit, just lock it in. So that's where we messed up there. Wayfair, I think we managed that one pretty well, but it just moved against us, and that's just going to happen sometimes. Meta, okay, this is one where we're going to start getting down to the trades that went well for us, because we talked about a little bit of red up front. On the back end, we had about $1,500 of winners. So let's talk about that. That's going to be a little bit more positive of a conversation. Meta, we knew that going into last week, again, we talked about this concept of the 1-year RSI a lot. Boom, it peaked up above 70. And this is why we love doing this, because it doesn't even necessarily need to take a U-turn for us and go straight down. All it needs to do is flatten out. And if you go on a 20-day basis, it's exactly what happened. It kind of ran into a wall at 290 a little bit. So our 292 short leg, 300 long leg, the 292.5, 300 call credit spread took home $151 because Meta finished below 292.50. And there you have it. The next one on the list, Penn, we got out of this one early, right? Learn the lesson, take the profit, bagged $124. SEDG, same exact thing. So very early in the week, we had a few bullish positions where we locked in $289 of profit. But again, SEDG, how did we find this trade? Where did it come from? Again, really, really nice bounce off this level. Back it up to the 1 year. This thing was oversold. It got blue on RSI. And again, this is a setup that we see a lot. Now, I do go back and forth sometimes because you'll look at how clean this bounces, and we entered pretty close to the bottom of this, and there was a lot more upside than downside. I shouldn't say that, but there was a lot of upside to this bounce right here. So sometimes I play with the idea of, if we nail a trade like this where we did enter right at the bottom, what is, maybe potentially a better idea? And we got a question from Cash about that Meta trade. What was max loss? Again, 7.5 debit, so it'd be a $599 loss, right? Width of the spread minus the credit would have been a $599 loss. But again, finished below 292.50, so we took home max profit there. But again, I do think sometimes, hey, a lot of these moves we get, and I think BE is a great example of one where we got in at the bottom here again, and it's up 25% from when we entered that one. But the way that we enter into these trades, we don't really get to capitalize off of that because we're entering in such a way that lets us, if we're assigned, we get to establish a position. And if it moves against us, we don't necessarily lose money off the bat. And to me, I think that's a great trade-off, especially when a market can be a little bit unpredictable. And I think things are running pretty high right now, so we definitely want that little bit of protection. But maybe just something to think about, right? Because a lot of these moves off RSI are going pretty well. So one thing that I have considered, and it would have worked pretty well for SEDG, is saying, hey, if we're comfortable that we've got a nice setup, what if we, sold a put, but then also bought a cheaper out of the money call? That way, if you get that early in the move week, it gets a lot easier to close out because you're closing out that further out of the money call for probably a pretty nice gain. And then if it moves against you, you're buying a cheap call against a put that you sold for decent premium, so there's still a net credit overall. You still get that concept of if it keeps falling against you, you get a little bit of a cushion. And then you're asking about cushion, faux life that I keep talking about. So cushion basically is, let's take a look at SEDG, for example, on the last 20 days. We had this big dip, so what did we do? We sold a 235 strike put for 260. Our break-even price on that was 232.40. And if I remove this red line, 232.40 is our break-even price. So if we want to talk about what is cushion, I'm basically referring to the gap between where we entered and where that break-even price is. So again, of course, selling a cash secured put is a bullish trade. However, we could still make money if it goes down, which is why we do what we do, right? This is the beauty of selling options and selling cash secured puts, because you could be entirely wrong and have it go down, but so long as it stays above this red line, right? So long as it stays above this cushion that we've created by the way that we've entered into this trade, we're still going to make money. And again, it finished way above this red line. We nailed that move, so that one was good. Nice 165 off that, but that's the idea of the cushion that we're establishing. Dish, another great example, right? And some of this is kind of like, hindsight bias in a sense because the market just ran up a ton. But again, this is when we entered right around 6, bounced back up to 6.6. That's a 10% move that we potentially could have taken a little more advantage of. But that's all right. I think the idea of if things move against us, and they will at some point, right? It gets really easy to forget about how bad the market can get sometimes when you look at, the S&P 500 and Nasdaq, and they're doing this year to date. That's just very irregular activity. Of course, it happens sometimes. It absolutely happens sometimes. That's why it's happened now. But 30+% in half of a year for QQQ, for Nasdaq, that is, and then about 15% for the S&P 500 in 6 months, when the average return is 9 to 10% per year. Again, we have to be patient. We have to understand that these things aren't normal. And the flip side of that is, if you look last week when the market went down 1.5%, we had our best week of the year. So it's not so much that the market's running away and we're having trouble keeping up with what we're doing. It's just more so that we're playing a little bit of a different game. And the game that we're trying to go for here is understanding the way that the market moves in waves and just generating consistent income. Even though June had some pretty gross months and had our second worst month of the year, we still made profit. We still generated income start to finish. And maybe it wasn't as much as we would like, but so long as we could have these losing stretches, quote unquote, and still pull money, I think I'm pretty happy. Of course, we'd love to get back to where we've got like a 11-week winning streak again, where we take home another 10 grand over that stretch, but got to be patient, got to be smart. There's no shortcuts in the market, and you'll get burned way more often than you won't if you try to take, an unreasonable gap up with something risky in your portfolio. So with that said, moving down here, SQ was one we just added as a bullish trade because we needed to balance out the portfolio a bit. Went really well. Now UAL, this one went pretty well objectively. It could have gone a little bit better, but I'm still pretty happy with how it went. So we talked about with RCL, we talked with Wayfair, ticker W specifically, about starting with the credit spread, selling the long leg for credit, and then letting the short leg ride. Because the idea here is you start with the credit spread above the current strike or the current price of the stock, and we could go to the UAL chart on a 20-ish day basis. This is fine. So again, 1-year chart, big picture, RSI got above 70. It was approaching previous, resistance. And look, there was a big red candle, spoiler alert. But this is what we were looking at. And then we had this massive, and again, we entered into it 623 end of day, right? So it was trading at about this level when we entered into it. And it really, really ran against us. Not so much Monday, but Tuesday, it absolutely ripped upwards from 53.50 to 56. And what do we know about 56, right? We started with the 54.56 strike spread. And again, this was for a credit of 64 minus 16. It was a 48-cent credit across 4 contracts. We were basically trying to take home about $200, a little under that. I think 192 is the correct math on that. So max profit would have been $192 on this trade. But Tuesday, it was running way against us, right? This was the long leg, this 56 level on our spread. And if it stayed at 56 or above, we would have hit max loss, which would have been about $600. And that is not something that I would have liked to do. So what do we do? Same thing as Wayfair, right? The second that long leg gets hit, you just close it for profit. And you go from a position where initially, right, we had that credit of 64 minus 16. So our initial break even was that 54 short leg plus the 48-cent credit. So again, this is the initial, I don't even know if I spelled that right, I can't see. The initial break-even price. And with one quick move, closing out these 56 strike calls, our new break-even price here is going to be that 54 short leg again, plus the 64-cent credit that we received, and then plus the profit here, which is the 0.73 minus the 0.16. And I probably should put an addition sign at the beginning of that so it calculates for me. So there you go. With one quick move, we go from this 54.48 break-even price up to a break-even price of 55.21. And again, that walks from, let's remove this line. That walks from here all the way up to here, 55.21. Now, this isn't massive, right? We know that the stock was trading up here, so we were still in a position where we were potentially going to lose money on the trade. But we had the idea, again, 1-year chart, RSI was massive. It was pushing 80. We felt it was overbought here. So if it moves even further than that, our conviction that this stock is overbought should only grow. So what that does is we end up with a short leg of 54. We've already taken profit on the long leg, and our break-even price has increased. Now, the great part about this is we remember that we said our initial max profit was only $192. By doing this, If this had expired worthless, we would have taken home a profit of 484. So we basically 2x the amount of profit that we could make. Now, finally, unlike RCL and Wayfair, we got a move that we wanted, right? On Thursday, it dropped from 56.5 down to 53.50. Now, why did we keep this open? We just talked about RCL, where we thought it would have been a good idea to close when we got that initial move, right? When we got this big red candle on RCL, we said it would have been smart to move. I think it's smart to leave UIL open, and the difference is because RCL, Royal Caribbean, happened on Monday morning, and there's just so much time left in the week. I don't know how that just came up, but on United Airlines, looking at that profit, even though it moved against us, right? Let's not forget that this thing started at 53.30ish when we opened the trade, and all of a sudden our bullish trade, or bearish trade rather, could hit 2x max profit even though it moved against us. But with 1 day left, I figured it was okay to kind of play the odds game, and it did not work in our favor, right? 54 was great. It moved up, fell back down, moved up, and eventually our hand was forced, and we said, you know what, we're just going to roll this thing into the following week, but we're going to keep the same strike. We're going to keep the same strike. We rolled it for a credit. So the great part about this is we know that our break-even price is 55.21. And with this credit that we get, we closed for 73 cents. Excuse me, we closed for 39 cents and we sold for 97. So the difference right there is going to be the 97 credit to open, 97 cent credit to open minus the 39 cent debit to close. So our new break-even price, our new break-even price, we could call it, is 55.79. So it's now all the way back up here, 55.79. Remove the drawing. Go back to maybe the 10-day. Our new break-even price is now up here, which is a much better place to be situated, in my opinion. And again, we talked about how if we initially hit max profit, we would have made 484 bucks. Now we're in a position where if we hit max profit and this goes down to zero, we're not making 484. We're making the 328 from last week, in addition to 388 from this week, and all of a sudden, instead of 484, it's $716. And that's at that same 54 price level. So that's the great benefit of rolling these things, rolling for a credit as well, and just hanging tight and leaving yourself in a position, again, that you can afford to hold in your portfolio. Because, again, if this thing runs up and goes up to like 56 again, and this is worth 2, we lose 400 bucks, it happens. But if it goes in our favor, we get 388, and that, adds up to a really nice overall profit on a trade that objectively could have moved against us the entire time that we were in it. So that is where we sit with that one. And I'm pretty happy with holding that. Again, very short week coming up. We've got FOMC minutes on Wednesday afternoon, 2 p.m. And I put together an economic calendar. Let me see if I could pull it up. I screenshotted it earlier. Here we go. Boom. And here is the weekly economic calendar. Now, important things to know. Monday at 1 p.m., the market is going to be closed early. So basically a half day in the market. And then Tuesday, the market is going to be closed all day. So if you are just an addict, cannot get enough of the market, of course, you could always go take a look at futures, which are dead flat right now for the S&P 500, minus 0.01%. But going back to this here, give me 2 seconds. I clicked the wrong thing on a different monitor. Again, this is the other kind of big ticket item, the FOMC meeting minutes. Now, there's some other items and events that were marked kind of as high importance. But I don't think anything is as important as, one, knowing when the market is going to be open next week, and then 2, the FOMC meeting minutes. But we've got some non-farm employment stuff. We've got more employment numbers on Friday, so that could speak a little bit to how the economy's looking. But to be honest, from a data perspective, the market definitely isn't as volatile based off of some of these data-driven events as it used to be. And by used to be, I mean when there was a little bit more uncertainty around rate hikes, and these economic factors were what were driving the Fed's decision. And, further, we're probably going to have Fed's view on future rate hikes by the end of the day, Wednesday. So Thursday and Friday, I don't know if I anticipate those impacting the market too much, but just always good to know in the back of your head, when's data coming out, what type of data is coming out, what time of day is it coming out, and then if there's anything that causes you to change your strategy because of that, then so be it. Just being informed is always incredibly important. But that's kind of down to the end of the list. PANW, this is one that we started with a credit spread, and this is not the price that I closed at, so we lost a little bit more money than I put on there. I got to redo this calculation. We closed that one out for $1.47. Bummer. We lost 439. But again, still profitable in June is what it is. So we closed that one for $1.47, and then we rolled that actually into a higher strike, right? So on this trade, the 255, 260 call credit spread, our max profit was going to be below 255, and we would have made 112 bucks. What we've done now is we sold a 77 257.5 call for 281, and we rolled for a credit. So again, this is another great situation where we were able to manage the trade. Let me type in PANW. And again, the only downside to any of this that we're doing here is that we have to wait an extra week. So this trade was going to hit max profit below 255. It moved above 255 just at the buzzer on Friday. So we kind of had our hand forced. We had to roll. But not all is lost, right? Because if we hit max profit here, we were going to do what? Make 112 bucks? Sweet. Now, if it stays below 257.5, we make 246. So again, it's 2x the profit we were searching for last week, and it's at a level that's higher than the 255, right? It's this level up here, which it did not touch last week. So we sit tight with that. We see what happens over the next 3.5 days. If we have to manage, we have to manage. But again, that 257.5 strike plus the 281 credit means that our weekly break-even price is above 260 all the way up here. So we have an even additional cushion, right? So max profit below this red line, profit overall below this red line. And then we just sit back, and if the stock gets above this red line, we'll probably add another. We'll cross that bridge when we get to it. But outside of that, not too much else to worry about there. Let's see what else we added that I don't have on this yet. So I'm caught up. UAL has been rolled. RCL has been rolled. We added a bullish position to complement this because, again, short call, short call, short call, short call, very bearish portfolio. Again, why are we doing that? The answer is because you go to the S&P 500, you go to the 1-year RSI that we've talked about, and it's a 68.11. That's huge. It's approaching a previous peak right here at 444.30. It is very, very close to that. Excuse me, it already made a new peak. Let's go. The peak here was 443.90. So again, very close to this, and at the end of the day, it kind of had a decently clean bounce off of that as it faded a little bit right at the end of the day. So that's what we're taking a look at there. We definitely are bearish due to that fact pattern, but let's finish out what we are holding for the coming week. So even though we have all these bearish trades, and I think being bearish is a good place to be, boom, we need to add some bullish stuff. We got to balance it out in case the market continues to move. So what we did is we sold some 7 expiry 28.5 strike puts on WBA, which is Walgreens. We did that for 27 cents. You know, you're not going to do anything crazy. We sold 4 of these, but again, potentially $100 of profit right there. And why did we enter into this one? Very similar investment thesis as kind of the rest of them. You know, 1-year chart, decent gap down on earnings. You go look at some of these price targets. You've got 31. You've got 42. You've got 29, which is not the best. 31, but there's no hard sell ratings after earnings. There's no one saying, you know, head to the hills, this stock is doomed. They're profitable. So a decent place objectively with a 32.62 RSI to start a position, in my opinion. So again, anything above 28.5, we're hitting max profit, which is right about here. You closed kind of right on the number on Friday. But again, of course, we have that 27-cent premium we received, so our break-even price is going to be 28.23. So we're good all the way down here. And if it goes below that, again, we've started with a smaller half-size position, so we could double down into that if need be, and then get our break-even price down below 28, which I think is a perfectly acceptable place to hold that. And if the market collapses and this one turns into a loss, and this goes to like 27.5, and it's worth $1, and we've lost 292, oh no, but if the market collapses, these other bearish positions are going to be crushing it for us. So not terribly worried about that potential. Moving further down, we added one other bullish trade as well, and that's going to be a Disney 7 expiry, 89 strike put, 71 cents. And it's really tough when the market gets overbought like this to find bullish positions to enter into, because a lot of stocks individually are overbought, obviously, when the entire market is overbought. So what we did is we entered into Disney. There's a decent level here, and again, huge emphasis on the half-size position here, because what this does is it's at 89 right now, which is all good and well. And but we sold it for a 71-cent premium, meaning our break-even price is going to be 88.29. And if I can tab back properly, there we go, 88.29. So we're protected all the way down here. And if it gets down there, so be it. What we're looking at right now is a 5-day chart for Disney. So not a ton of volatility on this one. Bigger picture, you're definitely establishing a position on the lower end of the 1-year range. So again, not really worried. We go back to the point I just mentioned about how when the overall market's overbought, it's pretty tough to find things that are relatively oversold. This one has an RSI of 42.34, so that is where we are situated on that one. So it's a little bit oversold, if anything. We've got one more weekly trade that we need to add to this, and then we've got a couple long-term trades that I'm pretty excited about that I think are going to be really useful to talk about, because I think there's a really decent opportunity there, especially when the market gets a little bit overcooked like this. So the last thing that we did was another bearish trade, and it's for SQQQ 77 18.5 strike puts, and we sold those things for 30 cents a pop. Ideally, max profit comes in and we hit 120 on that. So all in all, if things go really, really well for us and we somehow make max profit on everything, we're taking home about $1,900. Ideally, things go down and then we'll probably see a little bit of a loss on these two names right here, and that keep us somewhere in this 1,500, 1,600-ish area. But again, 3.5-day week. We don't want to be too heavy into anything. I think the RCL and Wayfair positions are probably our two riskiest positions that we have on the books right now. So we'll keep an eye on those, and again, try to learn the lessons that we had from last week. If we get a move in our direction, we'll just cut bait and keep moving. Especially Monday morning, right? Because we've got Monday morning, and then we've got Tuesday off entirely. So there's no more trading until Wednesday. But with that said, let's talk about these long-term trades that we put in on Friday. And we've got one that expires in August, and then we've got another one which expires in July. So one is 3 weeks till expiry. One is about a month and a half till expiry. And let's talk about what we were looking at here, what we saw, and why we entered into these trades, because I think they're pretty interesting. And it's, I think, a great way to potentially take advantage of some elevated premiums or elevated stocks. And we talked about something like RCL. We talked about UAL, where it's really important to give yourself the ability to sit back and wait for the move in your favor, because more often than not, a lot of these overbought and oversold moves play out the way that you want, but it might not be right off the bat. For example, NVIDIA is a great example of that. We had a hugely overbought stock. We were playing it down, and it kept running against us. And then we finally got that move back down when RSI cooled off a little bit back down below 70. And in that move, we did the same thing with these credit spreads that we talk about, right? We hung tight when the initial short leg got breached, because again, your break-even price, even on like a spread like this where the short leg's 420, your break-even isn't 420. Your break-even's 420 plus your credit. So it's not like you hit 420 and you panic. It can go all the way up to 431, and you could just hang tight. Whatever happens, happens. Max loss on this, $1,800. So again, defined risk, defined gain, max gain 1,100. We're basically looking at something 60-ish, I think off the top of my head, 65-ish% return on risk here, which is of course a great number. And let's talk about that NVIDIA trade really quickly to give some context before we get into this. So this 420, 450 strike call, we got cooked on it. It ran against us. This is what it looked like when it ran against us. We had these massive candles up. Now, one point that I want to make out, and it's one mistake that I think we made with that trade, is we actually did, off the initial overbought reading, we did get that fade back down. And we had the ability to take 60, 70% of max profit on that NVIDIA trade, and we did not do it. So that would be the one difference, because it's great with these longer term trades because you get the benefit of one, waiting if it moves against you, and two, if it moves in your favor, just take the profit, keep things moving. But the great part about this NVIDIA trade is if you really, really trust it the way we did, even though we lost $1,500 on a trade that we were going for $700 of max profit on, we rolled it out, finally got the move in our favor, and we made $1,250 on it, $1,250. So 2x the max profit on a trade that still, start to finish, moved against us. So I think there's a lot of flexibility to be had, a lot of great ways to manage these trades. Let's talk about the two new ones that we've entered into MongoDB and Restoration Hardware. So we'll type in MDB. And what do you see? And again, what do you see here? Let's look at this NVIDIA chart again. This looks so similar. You've got a massive earnings gap up. You've got an additional run after that. You've got an RSI reading that's above 70. What do we see here? We see a massive gap up from earnings. We see an additional run up. And then what happened after that additional run up when we had a 70 plus RSI? It faded back down. So we at least had the, patience, maybe restraint to hold off of that initial move right here. But then we've got this additional upward move. There's not a ton of precedent on this one. But if you look here and go to the 430-ish level, we love looking left on these charts because, again, we set up a trade where as long as this stock is below 430 come August 18th, we're going to hit max profit. And what do you see here? Back in the beginning of 2021, some beautiful resistance here. And again, it bounced off this level twice in the end of 2021 as well. So I think 430 is a really, really decent level. So again, max profit, I misspoke. Max profit is below 420, but again, our break even is 420 plus 11.3, so we make money basically below the red line. And what's great is, one, we already started to get a little fade at the end of the day, which is not much at all, believe me. But, when something runs this hot, it doesn't take a lot for it to come back down. And when it cools off a little bit, we had one initial, barely tiny breach of 70 back in August of last year. And what happened after that? I went from 386 to 135. I went down 60%. Insane. So insane move back down. And I think we may see at least a leveling out. More likely, I anticipate a little bit of a dip back down to this 400-ish level to retest the high 390s. So that's what I'm banking on. If we get that move, I'm perfectly happy to take $200-300 a profit and just get out of there. We don't need to wait the whole thing out to get the full $1,100 because you introduce a little bit of an additional risk there. So that's the plan there, and we've got until August 18th to wait. We've got 40-ish days. Let's see, how many days till expiry is this again? 47 days. So we can sit back and we could wait. RH, Restoration Hardware. This one's a little bit different, right? But again, defined risk trade. The most this thing could be worth is 20. That's a $1,500 loss. We're going for a 465 gain, which is a little bit less of a return on risk than this MDB call credit spread that we just looked at. However, the good part here is that we have a little bit more of a cushion and a little bit smaller of a time frame for this thing to move against us. So RH trading at 329.59. What do we see? Red hot RSI. This thing is 81.37. You'll see that right here when I move my mouse. 81.37 RSI on Restoration Hardware. And it's not just RSI getting elevated that gives us a bearish thesis, right? Because things can run red hot. They could keep going. They could be highly shorted stocks. This one isn't necessarily the case. Not hard to borrow. I think we're good to go there. But either way, we're protected by that credit spread. What I like to look at, though, is a little bit beyond that. And we're at a spot right now. We're at 330, which is where the stock currently trades. We extend that left. We're kind of running into where it previously took two U-turns. It took a U-turn in August of last year, and it took one in February of this year. So at least initially, when you've got 1, 2, 3, 4, 5, 6, 7 daily green candles in a row, something's got to give eventually, right? Kind of similar to this buildup that we saw back here in January, where there's 1, 2, 3, 4, 5, 6 green daily candles in a row. It got back to that 320-ish area and then took a U-turn from 320 back down to 290. And again, that's not to say that it can't go higher in the future, but all we need is this initial dip at any point. And even if we don't get the dip, right, what did we sell? We sold a 340 strike for 465. So our break-even price is going to be $344 right around here, which again, if you extend that to the left, keep going, looks even better. Hits this second little blip that we had at the beginning of February for Restoration Hardware. So really happy with that one. And if it moves in our favor, fantastic. We could probably take 50% of the profit right there. And if we close this thing out for 2, we're bagging $265 in a week, and it's no different than just a decent weekly trade. In fact, probably a little bit better than a normal weekly trade. But if we can bag a few $100 and close this for 8, all of a sudden, whatever week pops up, that's $600 of profit to supplement us off of trades where, in theory, if they move in our direction, are never really going to be too close to being in a lot of danger. So again, this is our profit point on RH, decent cushion there. And here's our profit point right there as well. Decent cushions, decent amount of time, and thanks to the fact that we have these defined risk trades, we can sit back and wait. And if, MDB doubles tomorrow or Restoration Hardware doubles, again, we have a defined loss. It's not going to ruin the account, but I think we can be patient, almost treat it like they're crops, right? We plant these longer term holdings. We keep an eye on them. They're going to go up, they're going to go down, they'll move around. The premium will shift during the lifespan of the trade, but eventually we'll have a day where we look back and maybe see, oh, it's up a couple $100 today. We could say, hey, let's figuratively harvest the crops, let's take our profit and move on and find another one. A lot of opportunities like this in the market right now, especially anytime the S&P 500 gets too far one way or the other on the RSI perspective. And again, this applies to oversold stuff too. It's just we are not on that side of the market right now, but a lot of different opportunities like this out there. And one other thing that is important about this is we are trying to target stocks that aren't necessarily that great either, where I wouldn't like them anyways, and just that high RSI is an additional bearish thesis. MDB is a good example of that because they've got a really, really poor valuation. In fact, if you go MDB forward PE, I've already Google searched it. We know that the average PE ratio in the S&P 500 is about 20-ish, low 20s right now, maybe a little higher after the run up. But the forward PE today is 351.68 on MDB, according to this website. So that is a massive, massive, massive number, implying what? Implying that it is incredibly overvalued right now. And right now they don't even have earnings. They have negative earnings, MDB does. So if you were to go on like the Market Watch tab and pull up MDB and you want to look at the price earnings ratio, what are you going to see? It's negative 83.51. And I think maybe a better question from an exercise perspective is, how did we identify this? A great thing we could do here is go to the scan, find something that's overbought, sorting by RSI, and then if we go search stocks, we're in high ROR puts. What we could do is actually bring that price to earnings ratio in here. If I can spell, we could bring that in, and then as we look at our results, we know that okay, top to bottom, these are the most overbought stocks with decent option premium on them. We could say, hey, this one right here, negative 37 PE, that's pretty overvalued. Overstock right here, negative 25 PE. That's pretty overvalued. So if we take a look at OSTK, for example, we know that they're not making money. We know that they're overbought. We know that they've had a huge run up to where RSI is 79.58, and we know that on a one-year chart, it's approaching 35.2, which is the previous high. So maybe that is a situation where you could say, hey, maybe a week out, let's see what the option premium's looking like. I could maybe open like a 35, 37. Why 35? Again, because that's the previous high. We could go with the vertical 35, 37 spread 1 week out. Maybe bag 27 cents a premium. It's not huge, a little bit out the money. But yes, on the 1 week, it's not a ton of cash. However, if you back this up to like even just a monthly expiry, all of a sudden, your return gets a lot better there. You're looking at $450 on a similar position. And you probably would want to make it a little bit wider to save yourself a little bit of cash on commissions there. But that's the idea behind that type of trade. And if you wanted to set it up similarly to what we did with, with what we did on MDB, where you make it a little bit longer term, boom, you could go to August, 35.40, and your break-even price will be 36.20. And that's all the way up here. So as long as this stock, which is already very overbought and probably liable to come back down, as long as this doesn't go up to this line, you set yourself up with a very similar position to what we had established for MDB. And again, that's just a great way to go through your scan, see what's overbought, and say, okay, we know that RSI being high is pretty bearish. What else is bearish? Having a bad valuation is bearish. So anything where you've got an exceedingly large negative or exceedingly high positive, which again, PANW 400.42, we're short on that one as well. Those are probably your primary targets. You could take a look at LI, negative 210, but it's 66.79. We want to wait typically till it gets above 70. But IONQ is probably another decent one. Now the tough part about these is it's not a secret that these stocks typically suck. It's not a secret. So this one probably is a little bit tougher to borrow, and you've got some decent call premiums up there. But again, not the worst setup in the world. Ideally, you enter when it's up near 14, but still, you could probably pull off like a 14 to 15 strike call credit spread here. Purchase that back end and still, have a decent-ish trade for the coming week. But that's the idea with those. That's one thing where we're probably going to focus a little bit more of our scanning on, those types of valuations as things get overbought. It's not enough to say, hey, here's a quick overbought scan. We're just going to go top to bottom of the list. We want to say, hey, we want an additional layer of bearish thesis behind those numbers. So that's the idea there. But again, all in all, sucks that we lost money last week. Is what it is. We still finished out June with money. And more importantly, we finished the front end of the year with about $20,000 in profit, meaning we took home an 11.2% return. Our average return per month was about 1.8%. And again, if you take the calculator out and you go 1.0, let me think, 1.108. I'm being really stupid right now live. 1.08%. There we go. The sub right there, Jay. 1.08. Okay, there we go. And you multiply that by 1.0108, what you're going to end up with is 2 months, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Maybe I'm doing the math wrong here. This is what it is. But again, still, you're going to have like a 15-ish plus percent return. And I think a lot of that's inflated because we had a pretty big first month. But point being there is, as long as you're targeting, this 1+ish% level, you're going to compound to return on a yearly basis that is better than what the market typically averages. And again, year-to-year basis, 9 to 10% in the S&P 500. We are trailing that this year, but we're on track if we double this return to be 20+%. That's probably my goal for the current year, to get up to that 20% number. So if we get there, I don't care if the S&P 500 and NASDAQ go up 100% apiece. We have done it in a way where we've combined, honestly, primarily bearish positions over the past couple months in the face of this run-up. So we're not relying on the market. We're just playing the market and playing what it gives us. So it could go down, it could go up. We still want to put ourselves in a position where we're able to generate consistent premiums. So doing things like identifying these decent long-term short opportunities, continuing to roll positions week after week after week, not necessarily paying attention to if we underperform by 2.5% on a week, because if we go 1 week back, we've outperformed by 3.5%. We just need a little bit more of that red to come in. We know that historically, these types of returns in the overall market are not typical, but we have to be logical here and understand that there's nothing stopping these stocks from continuing to run unabated and just continuing to move up indefinitely. Realistically, no, that's not going to happen. But if you try to time it and really put all your eggs in a basket in a given week, you're going to get crushed. So we stay on the bearish side until RSI comes back down. And again, we're long-term bullish on the market. We're long-term bullish. One other thing that I think is important to have is a long-term holding account. So if you're getting hammered on the bearish side in your trading account, one thing that may help the mental health a little bit is flipping the tab, taking a look at your long-term holdings account and seeing a little bit of profit there. But that's what we got set up for the week. We had a really successful, I think, first half of the year. Did underperform. Of course, our goal is to outperform. But if you look at what we've been doing since we started, we are more than accomplishing that goal. So confident that if we continue this process that we've built, as you can see, we have refined the strategy. We've had a couple pretty big dips that we've talked about. We've changed and adjusted the strategy to become more of a consistent income generation strategy, as opposed to just trying to mass collect option premium at considerable risk levels. And you could tell by the way that this curve is, not necessarily flattened out, but is steadied out a little bit. What you don't see are these heart-stopping jumps. And in fact, these little dips here basically are new heart-stopping jumps, which I am perfectly okay with. So that's the plan. And that's our stream. So to those of you who spent your July 4th weekend, Sunday night with us, thanks for tuning in. If you're watching on YouTube, again, thank you equally if you made it all the way through to the end of this video. We've got a new newsletter. I guess I don't even think that's a tongue twister. I don't know why I'm struggling with that one. But we've got a new newsletter that we are going to be launching again. We did one a couple years ago, but we've got a new one built out, which I think is going to have a lot more relevant information to help you, because we talk a little bit about where we find this information, what it is, how we use it, and then deploy it when we find trades. But it's a quick, easy newsletter that we're going to send out at the top of the week, Sunday nights typically. And going to have some really nice, concise information for you, so you could, see earnings calendars. You can see things like economic calendars, understand expected moves, and see what the different results of our scans are. So have to give you some trade ideas as we go into the week. But that's all we've got. Until next time, this has been the Hourglass Trader, where as time passes, we make money. We didn't do it last week, but we are going to try our best to do it again this week, and hopefully we talk again a week from now with a little bit more money in our account than we currently have. Hopefully a lot more money, to be honest. But That's all we got. Sign up for the newsletter. The link's in the Discord server, I think in the main chat room, and that's going to go out a little bit after this ends. And there's no point in me rambling and keeping you guys any longer. Appreciate it. See you guys later.